Money Vikings, Money Viking G here. Welcome back to the show. Thank you for giving me an opportunity. Thank you for giving us an opportunity to add value to your life, true wealth life. I'm wearing my orange Bitcoin glasses today. I do kind of like these. And it's interesting. I'm going to talk today about strategic portfolio asset allocation. And of course, Bitcoin has not done what we thought it would do. And I'm going to use that as a little bit of a lesson about feeding into strategic allocations of assets in your portfolio, because strategic asset allocation is a critical skill that has to be understood deeply, and it needs to be understood in the context of your own goals, your own risk tolerance, and your own lifestyle and what you're sort of going for. And it really can't be anything just sort of like max out, the best value and get the best return. That's a little too naive. It's a little too elementary. The fact of the matter is that no one knows from year to year what asset a year from now, or what stock, or what ETF, or what crypto, or what piece of real estate, or which business is going to do the best, quote unquote. No one knows. So the number one thing then is that you have to be careful about advisors. So advisors that are charging you a high fee because you're thinking that they know more or have some sort of secret insight, that is not an advisor that I would use. I would use a fiduciary, number one. I would talk to someone who has low fees, and I would talk to someone that has the long-term, sort of a grounded approach to things. And that's what I try to express at Money Vikings, is a very long-term, medium-term, grounded approach to wealth building. So my current asset mix is something along the lines of this. It's not exact, so, I'm not going to show you everything and it's not going to be exact, but I'm trying to give you the rough sketch of what it is. And it's about 40% things like the S&P 500 and the Schwab Dividend Fund and the VDADX, one of my favorite Vanguard dividend funds. So it's that to me is a core aspect of a thoughtful portfolio. Now, is 40% the right number of total assets? No one knows. Only I know. It's a choice. It's a personal choice. So anyone that tells you, well, it's got to be 80 or it's got to be 20 because the market's going to crash, or it's got to be 60 because of your age, or whatever it might be, there are rules of thumb, but you have to decide. You have to decide what works best for you. With that specific investment, what you find is that the S&P 500, the dividend funds like that with the greatest companies, excuse me, what you find with those is that over a decade, over 20 years, over 30 years, they return about 10% average returns. There's years it goes up 20%. There's years it goes down 3%. There's years it does 7% return. There's years it does 30% return. Every once in a while, there's years that it drops 30%. So all that happens. So I just dollar cost average into that, and over time looking for that 10%, return. With a 10% return, what you're looking at doing is basically doubling the value of that portfolio every 7 years. And then if you're continually adding to it, by the time someone gets to the end of a 30, 40-year career in something that they somewhat enjoy and are somewhat good at, what they find is that they could have $800,000. They could have $600,000. Maybe they'll hit $1 million, whatever it might be. That's one aspect. Okay, so that's 40%. 20% in bond funds. Why bonds? Bonds to me, so bonds are a lending instrument. You're lending your money to municipalities. You're lending your money to companies to expand. And what they're doing is they're paying you typically a set interest rate back. And then at the end of the maturity of that bond, they're giving you the rest of your initial money back. They're paying you back plus interest. To me, bonds are a cushioning thing. it's something that kind of balances out the sort of volatility at times of the stock market. So the stock market at times can just be really neurotic on a day-to-day, week-to-week basis. And so you might have one of these weeks where it just takes a huge plunge, and the bonds kind of buffer that. So if you have an investment account with $200,000 in it, if you have some of that in bonds and there's a rough week in stocks, you might see it drop to 160 or something like that on a week-to-week, month-to-month basis. But it won't go from like 200 down to 100. That can be shocking to someone's psyche. So that's the idea behind the bonds. Okay. The next bucket is 20% real estate. So I'm a long-term believer in real estate, and I know that's hard for a Bitcoin guy because a lot of Bitcoin maximalists, as you would say it, are sort of, anti this, anti that. And I do see a lot of talk about real estate. I'm not anti-real estate. Real estate to me is a very important asset class. It is constrained in a lot of ways by supply. There is only so much real estate, so you have that advantage. And number two, things can be done with real estate. Real estate can be modified and changed and shifted to increase its profitability and add more value to humans. So I do think those two things are a good nexus into a strong investment vehicle. I like real estate investment trusts, Vanguard VNQ, there's a bunch of them. There's individual REITs like Realty Income, etc. There's tons of things, but I think it's a nice way. The REITs are a good way to be diversified in your real estate. Now there's also privately held real estate. You can buy an apartment building, you can buy a duplex, you can buy a single family house, you can rent it out. That has to be treated as a small business. Those are a lot of work. It's not passive. People will tell you real estate's passive. Well, this is what I've found after 25 years of real estate investing. It's passive for like 6 or 7 months at times. And then it's really not passive. Then it's really, really active. And it takes a lot of management and a lot of skill and at times a lot of cost. So you could have it quiet for a year. You could have it quiet for a couple years. The rent checks are coming in. Everything's being paid. You're covering everything. You're making a tidy, little profit each month. But then you will have those years and those times when a tenant will mess something up, break something. Things will break naturally. You have a lot of things to fix. So there's times when it's very, very active. It's not passive. It can be, like I said, it can be passive part of the time and it's active another part of the time. So the 20% real estate. So the final 20% bucket is Bitcoin and alternatives. This is the area where, so the Bitcoin in my mind is a hedge against inflation, monetary policy, printing of money, national debt. There are these macro issues that none of us have any control over. They're going to devalue our dollar. They're going to erode our purchasing power over time. I still believe in the use case and the thesis that Bitcoin, it will be able to mitigate that. I think a lot of people that watch Money Vikings know I'm not a Bitcoin maximalist. I don't do everything in Bitcoin. I believe in strategically diversified portfolios as I'm going through here. But I do believe that a certain chunk could be a healthy addition to a portfolio. So I'm in that sort of 10% range right now, and that's what I'm personally comfortable with. Now, there's also other alternatives. I like to take sort of long shots on various individual stocks, but not much of that. A little options trading here and there. Jerry's really good at that, with his covered calls and that kind of stuff. And that's where I keep that 20% bucket. It's kind of some of that. It's like cutting edge, maybe some of the AI stuff, some of the more, very tech forward things that can be risky, but can also add a lot of value if they do really well. But they don't always do well. Sometimes these things don't work. They are higher risk. So that's where I'm at, folks. Strategically diversified portfolio. I just laid it out for you. That's where I'm at in terms of at the beginning of 2026. I don't make major changes. I'll make adjustments here and there. If the S&P spikes even more, it might take a little bit off the table. Who knows? Maybe not. Maybe we'll just keep it going. So with that, I'd love to hear your comments. What's your portfolio mix looking like going into 2026? And, feel free to criticize or critique my portfolio. I'm making no assumptions or assertions that it's the perfect portfolio, because it's not. No one knows what the perfect portfolio is. And if anyone tells you otherwise, they are selling you something. So thank you very much. Please like, subscribe, share. I'd really appreciate it. Also look in the new year for our book, True Wealth, The Money Viking Way, which will be published here in mid to late January. And very excited about that. It's going to be quite the Bible of conquering financial freedom and personal finance for people, and it'll be a really powerful tool for people. Take care. Happy holidays. Merry Christmas.